You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Welcome to the deep dive. We are jumping into a pretty high-stakes world today. We're looking at three alternative investment vehicles: options trading, cryptocurrency, and equity crowdfunding.
Yeah, these are the ones that really grab headlines, aren't they?
Totally. They're volatile, complex, definitely often misunderstood. But, they've also created serious wealth, funded some really innovative companies, and, I guess, opened doors that used to be locked for most people.
Right. But that's the key thing, isn't it? Access is democratized, sure. But outcomes, not so much. So our mission today is really to cut through that hype. Let's break down the mechanics, the real risks, the potential rewards, and help you figure out, are these actually worth the gamble for you, given your situation?
Okay, sounds like a plan. Let's start with options trading. That seems to be where a lot of people dip their toes into, more complex finance. You see it all over social media, right? These incredible gains, people making 10 times their money.
Yeah.
And then the horror stories. Accounts just wiped out.
Mm-hmm.
Yeah.
It's definitely got that allure.
So fundamentally an option, to contract, gives you the right, not the obligation, to buy or sell something at a set price within a certain time.
Mm-hmm.
We probably don't need to rehash call versus put basics, but the leverage part,
yeah,
that's crucial.
No, exactly. That's where the power and the danger really lie. See, you pay a relatively small amount, the premium, for that contract, but that small premium controls a much larger value, usually 100 shares of the underlying stock. So if that stock price moves just a little bit in your favor, say a few dollars, your initial investment, that premium, can just explode, double, triple, sometimes 10 times your money in days.
Wow. Okay, I see the appeal.
But, and this is the big but,
Yeah, here it comes.
that leverage works exactly the same way going down, maybe even faster. You can lose everything you put in basically instantaneously, 100% loss.
Okay, so that brings us to that statistic we found. It's pretty stark. Somewhere between 75 and 90% of retail options contracts expire worthless. Is that right?
That's the number you see cited frequently in studies, yes. 75 to 90%. It means the vast majority of people buying these short-term options for speculation, they're losing that premium.
So if the failure rate is that high, why is it so accessible? You'd think regulators would be more, restrictive.
Well, it's a complex issue. The argument is often that the instrument itself isn't the problem, it's how it's used. Think about professional traders, institutions. They often use options for hedging, like insurance, protecting their existing stock positions.
Okay, so risk management.
Exactly. But a lot of retail use, especially what you see hyped online, it's pure speculation. Just betting on short-term price swings. It's a completely different ballgame. And regulators tend to put the onus on the investor to understand the risks of sophisticated products. Caveat emptor, buyer beware.
And understanding it means getting into the weeds, doesn't it? We're not just talking simple buying calls or puts. There are dozens of strategies.
Right.
Iron condors, butterflies. What else? Straddles.
Oh yeah, the playbook is deep and complex, multi-leg strategies that require precise execution. And then you absolutely have to understand the Greeks.
Oh yes, the Greeks. Sounds intimidating.
Well, they are crucial. Delta, gamma, theta, vega, rho. These aren't just fancy names. They measure how things like time passing or changes in volatility or the stock price itself affect your options value. If you're trading options and you don't grasp what those mean, you're basically flying blind. You're gambling, not trading.
Can we pause on theta for a second? You mentioned that one specifically.
Yeah, theta is huge, especially for buyers of options. It's time decay. See, unlike owning a stock, where time can be your friend, letting the company grow, an option is a wasting asset. Every single day that goes by, it loses a little bit of its value just due to time running out.
So you have to be right about the direction and the timing.
Yes, exactly. Theta is constantly working against the option buyer. It's this invisible headwind. If you don't factor that in, well, you're missing a massive piece of the risk puzzle.
Okay, this paints a pretty daunting picture for the average person. But we did see some less terrifying uses mentioned, right? Like covered calls.
Yes, absolutely. There are conservative strategies. Covered calls where you own the stock and sell a call option against it, that can be a way to generate income. And protective puts buying a put option on stock you own that's literally portfolio insurance. It limits your downside.
So it comes back to the tool analogy.
Precisely. Options are tools, like a chainsaw. In the hands of a trained professional, it's incredibly useful for specific jobs. In the hands of someone who hasn't read the manual, it's a recipe for disaster. The knowledge required is significant, and the risk is front and center.
Got it. Okay, let's shift gears. Let's talk crypto. If options felt complex, crypto adds this whole other layer of, like, technological complexity on top of financial risk.
Oh, definitely. It's a whole different ecosystem.
So the basics. We're talking digital money, right? Running on a blockchain, this decentralized sort of public ledger. Started with Bitcoin back in 2009. The big idea was, what, financial sovereignty? Money outside the control of banks and governments?
Yeah, that was the initial spark. That promise of censorship resistance, peer-to-peer transactions, programmable money with smart contracts, and, banking the unbanked. Big revolutionary ideas. And that's why it attracted so much attention from individuals to huge institutions.
But the reality check comes pretty quick with crypto, doesn't it? The volatility is just wild.
Off the charts. Compared to traditional markets, it's a different universe. I mean, look at Bitcoin. We've seen it crash 70% or more. Remember 2022? From nearly $70,000 down below $16,000. Unthinkable for something like the S&P 500.
And that's Bitcoin, the biggest one. The smaller coins, the altcoins.
Forget about it. 20, 30, 50% swings in a single day. That's Tuesday in altcoin land. And many of these projects just fade away, lose 99% of their value, or go straight to zero.
Which raises that question about diversification, right? People
Yeah.
used to say crypto was good because it didn't move with stocks.
That was the narrative, yeah. Low correlation. But what we saw in more recent downturns, especially in 2022, is that crypto, particularly Bitcoin, started trading more like a high-data tech stock, like a leveraged NASDAQ play. When risk assets sold off, crypto sold off too. Hard.
So maybe that diversification benefit isn't as strong as people thought, especially when you need it most in a crash.
It's definitely less clear-cut now, needs more scrutiny, and beyond just the price swings, you've got this whole other dimension of risk specific to the space. Security fraud.
Right, the scams. It seems like they're everywhere. Ponzi schemes, pump and dumps. What was that other one? Rug pulls.
Rug pulls, yeah. Classic crypto scam. Developers launch a token, hype it up, attract investment, maybe provide some initial liquidity, and then boom, they pull all the valuable assets out of the liquidity pool and disappear, leaving investors with worthless tokens.
Nasty. And it's not just shadowy figures, right? We saw massive, supposedly legitimate companies collapse. FTX comes to mind.
FTX was a watershed moment. Billions in customer funds just vanished. It showed that even with this decentralized tech, relying on a centralized exchange, a trusted middleman, well, that trust can be catastrophically broken. Fraud, mismanagement, total loss for customers.
And the security burden is all on the user, too, if you hold your own coins.
100%. Self-custody means you are the bank. If you lose your private keys, those secret passwords that control your crypto, your money is gone. Gone. Forever. No customer support line, no password reset, no FDIC insurance, nothing.
That's a level of personal responsibility most people just aren't used to with their financing.
Not at all. It requires technical diligence.
Okay, so extreme volatility, rampant scams, major collapses, complex security. Why are people still drawn to it?
Well, two main things, I think. First, the potential upside is still astronomical, right? We've seen coins go up thousands, even tens of thousands of percent. That possibility, however remote, is a powerful draw. And second, there's the technology itself and increasing institutional adoption. Bitcoin ETFs, companies putting Bitcoin on their balance sheets. It adds a layer of legitimacy.
But fundamentally, it's still speculation for most coins.
Overwhelmingly, yes. For most cryptocurrencies, you're not buying a share of a company that produces cash flow. You're essentially betting that the technology will gain wider use, or simply that someone else down the line will pay more for it than you did. It's why most advisors say, look, if you want exposure, keep it small, like 5% or less of your total portfolio. Treat it as highly speculative.
Right. High risk, potentially high reward, but definitely not the core of your strategy.
Exactly.
Okay, let's pivot to the third one. Equity crowdfunding. This feels a bit different. We're talking about actually buying shares, ownership in private companies. Startups. Stuff that used to be only for venture capitalists or, accredited wealthy investors.
Yeah, this landscape changed dramatically thanks to the JOBS Act back in 2012. That legislation basically created the framework for platforms like Republic, WeFunder, Start Engine to allow regular people, non-accredited investors, to put relatively small amounts of money into early-stage private companies in exchange for equity.
Which sounds amazing, right? Getting in on the ground floor of the potential next big thing.
The appeal is definitely strong. You get exposure to that potential for venture capital style returns, which can dwarf what you see in the public markets if you hit a home run. Plus, there's often an emotional connection. You might invest in a local brewery or a tech company with a mission you really believe in. You can build a diversified portfolio of these tiny bets in private companies, which was impossible before.
Okay, but we know there's a catch, or several catches. What are the big risks here?
The biggest one is just the brutal reality of startup failure. The data consistently shows that somewhere between 70 and 90% of startups ultimately fail. They just don't make it. So you have to go in assuming that most of your individual bets in this space will go to zero. They'll be worthless.
70 to 90%.
Yeah.
Wow, okay. That's sobering.
It is. And even for the ones that do succeed, you face the issue of illiquidity. These aren't like public stocks you can sell tomorrow on an app. Your money is locked up. You might be waiting 5 years, 10 years, maybe even 15 years for a liquidity event, basically, the company getting acquired or going public, IPO. And there's absolutely no guarantee that event will ever happen, even for a decent company.
So you need extreme patience. And you might still end up with nothing to show for it.
Precisely. Then there's the information problem. Public companies have strict reporting requirements. Quarterly earnings, audited financials. Private companies, especially raising through crowdfunding, much less disclosure. You're often working with less information. And the valuation, what the company claims it's worth, is set by the company itself, often negotiated with early investors. It's hard for an outsider to know if it's fair.
And isn't there a risk that the reason they're crowdfunding is because they couldn't get money from traditional VCs? Like a selection bias?
That's definitely a factor sometimes. Adverse selection. The best startups with the clearest paths often attract VC money first. Crowdfunding can be a great option, but sometimes it's plan B or C. But maybe the biggest, most complex risk, the one people really overlook, is the structure of these deals.
What do you mean? Like the terms?
Exactly. It's not always straightforward equity like buying Apple stock. You might invest via something called a safe note or a convertible note. And then there's dilution. As the company raises more money later at higher valuations, its initial percentage stake gets smaller. And crucially, liquidation preferences.
Okay, what's that? Sounds important.
It's critical. Later stage investors, especially VCs, often negotiate terms that say when the company is sold, they get their initial investment back first. Sometimes 1x, 2x, even 3x their money back before earlier investors, like the crowdfunding folks, see a single dollar from the sale.
Whoa. So the company could sell for a decent amount, but because the VCs get paid first, the early crowd investors could still get wiped out.
Absolutely, it happens. You backed a successful company, it exited, but the exit price wasn't high enough to clear those preference hurdles, so the common equity holders, including crowdfunders, get zero.
Man. Okay, so you really have to approach this like a mini VC. Expect most bets to fail, hope for one big winner, understand the lockup period, and really scrutinize the deal terms.
That's the mindset, exactly. Diversification across many deals is key, and accepting the high probability of loss on any single investment.
All right. We've covered options, crypto, equity crowdfunding, lots of complexity, lots of risk. Let's try to pull back and see the big picture. What are the common threads here?
Well, the first big one we touched on earlier, democratization of access is not the same as democratization of outcomes. Just because it's easy to click a button and buy this stuff doesn't mean it's easy to succeed. Easy access has, frankly, led a lot of people to take risks they didn't understand with money they couldn't afford to lose.
And that's fueled by the hype machine, right?
Yeah.
Especially social media.
Oh, massively. Social media creates intense survivorship bias. You see the Lamborghinis, the 10-bagger option trades, the early Bitcoin millionaires. You don't see the thousands who lost their savings quietly. So people dramatically overestimate their own chances of success. FOMO, fear of missing out, drives a lot of speculative behavior.
Yeah, that makes sense. What else?
The absolute necessity of knowledge and skill. You can't just wander into these arenas and expect to do well long term, whether it's understanding option pricing models, securing your crypto assets properly, or evaluating a startup's business plan and cap table. Success demands real expertise. These markets punish ignorance severely.
But haven't the platforms tried to make it easier, like commission-free trading, slicker apps? Doesn't that lower the barrier?
It lowers the barrier to entry, absolutely. which is part of the problem. It removes the friction to participate, but it doesn't remove the inherent difficulty or risk. You can buy that complex option in seconds now, sure. But the math behind its price, the theta decay, the volatility risk that hasn't changed, the physics are the same. Easier access hasn't made profitability any easier. In fact, it might make it harder by encouraging impulsive decisions.
Okay, so given all that, complexity, risk, hype, let's lay out some clear guardrails. We distilled 7 principles from the sources that seem to apply across all these high-risk alternatives. And yes, some might sound basic, but in the heat of the moment, with these kinds of assets, people forget the basics.
Absolutely critical to remember these. Okay, principle 1, never ever invest money you cannot afford to lose, period. This has to be truly discretionary capital. If losing 100% of it would impact your rent, your bills, your essential life, don't do it.
Right. Principle 2, understand what you're investing in deeply. If you can't explain the risks like theta decay or impermanent loss in DeFi or liquidation preferences to someone else clearly, you shouldn't invest. Don't just chase buzzwords.
Principle 3, start small, really small. Your first forays into these areas should be about learning, not earning. Use tiny amounts of capital you're prepared to lose entirely, just to gain experience. Make your mistakes cheaply.
Good one. Principle 4, diversification still matters, maybe even more here. Don't put all your speculative capital into one options trade or one random altcoin or one startup. Spread your bets to increase your odds of surviving the inevitable losers.
Principle 5, have an exit strategy before you invest. Decide your profit target and, just as importantly, your stop-loss point, the point at which you cut your losses. Write it down. Stick to it. Especially vital in crypto, where markets never sleep.
Principle 6, be brutally honest about why you're doing this. Are you making a calculated investment based on research and risk assessment? Or are you chasing excitement, gambling, trying to get rich quick? If it feels like playing a game, you're probably gambling.
And finally, principle 7, maybe the most important. The boring stuff still matters most. Your foundation for building real lasting wealth should be traditional, proven investments. Stocks, bonds, real estate, low-cost index funds. These alternatives we've discussed, they should be at most a small satellite part of your overall portfolio after the foundation is solid.
Okay, so that brings us back to the main question we started with. Are options, crypto, equity crowdfunding worth the risk?
The nuanced answer is, they can be, but only under very specific conditions. 1, you possess the necessary deep knowledge to understand the specific risks and mechanics. 2, you have fully accepted the high probability of significant, even total loss. And 3, you limit your exposure to a small, truly disposable percentage of your overall net worth.
So for most people, these probably shouldn't be a priority.
For the vast majority of people, no. The priority should absolutely be getting the fundamentals right first. Build that emergency fund, max out your tax-advantaged retirement accounts, pay down high-interest debt, consistently invest in diversified low-cost index funds, nail the basics.
Get that solid foundation built before you even think about adding these volatile layers on top.
Exactly. Build the pyramid from the bottom up.
Okay. So a final thought for everyone listening to maybe chew on. Investing isn't supposed to be thrilling entertainment. It's supposed to be effective. And boring and wealthy beats exciting and broke every single time.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.